You do have now more private companies that are sitting in VC portfolios and private equity portfolios. And I think that has forced more asset managers, more money managers to start to add alternative investments as part of their core portfolios, because again, that growth used to sit after an IPO in a public fund. Now it doesn't sit in that public fund, it sits privately.
If you're listening today, it must mean you're a strategic CFO. Tune in regularly for tips, best practices, and eye-opening stories that will help you optimize your CFO experience. And don't forget to leave a review and subscribe.
Hello and welcome to FEI Silicon Valley's Strategic CFO Podcast, a series of conversations with business and government leaders that impact our lives here in Silicon Valley. My name is Jan Robertson, your host, past president and current board member of FEI Silicon Valley. My guest today is Brett Mock, who is chairman of NASDAQ Private Market International Division. And his role is leading the company's expansion efforts for its secondary liquidity solutions worldwide. So let's delve into that. Welcome, Brett.
Thanks, Jen. Thanks for having me.
Pleasure. Thank you. So let's start, first of all, NASDAQ Private Market. Why don't you tell us a little bit about what NASDAQ Private Market is, your role there, and I'd love to hear more about your background and how you got into your current role.
Yeah, sure. I guess taking the first question first, NASDAQ Private Market, their core client are private companies, the issuers. NASDAQ, our former parent company, acquired the asset in the early 2010s with some regulatory changes and as well as the recovery off the great financial crisis, and realizing that there were more companies that were waiting to go public longer and needed liquidity solutions. And NASDAQ, I think, was concerned that maybe there weren't going to be as many IPOs, or maybe these companies were just going to stay private for longer. I mean, if you look at Facebook, that was one of the true sort of watersheds, because that was such a large company that had stayed private for a decade and then came public at a very large valuation. Historically, companies would get founded and within 5 years, they would hire a banker and file an S1 and do an IPO, and they came public as a small cap company in the 50 million, 100 million, et cetera. And they would then grow in the public markets, and those companies would hopefully grow revenue and grow product and become a mid-cap company, and then hopefully become a large-cap company. I think Amazon came public in the mid-90s as a $500 million company or less. It was not a huge company when it came public. Microsoft, the same in the 80s. What's changed is the fact that companies have decided to stay private for longer for a variety of reasons, some of which were regulatory changes during the 2000s. So you had, coming off the dot-com and Enron era, you had Dodd-Frank, Sarbanes-Oxley, Reg FD, of course, the great financial crisis regulation during that whole sort of 10-year period, I think made it more expensive and more friction of becoming a public company. And of course, during the great financial crisis, we had to recover. So there wasn't a lot of activity for a couple of years then. And then along comes Facebook, and that really, I think, changes the perception that these companies can be big and stay private for a long time before going public. And I think that started this sort of new generation of technology companies of staying private for longer, which is the theme. The average company in the year 2000 came public at around $100 million and within 5 years of being founding. And today, they stay private for 14 years and they come public around a $5 billion valuation. So you've got quite a change in the behavior in capital markets. I think if you look at the peak number of listed companies in the United States in 1996, there were about 8,000, and today there's 4,000. So a 50% haircut in the number of available public companies which go into indexes and 401k plans and ETFs and stuff like that. So, you do have now more private companies that are sitting in VC portfolios and private equity portfolios, et cetera. And I think that has forced more asset managers, more money managers to start to add alternative investments as part of their core portfolios, because again, that growth used to sit after an IPO in a public fund. Now it doesn't sit in that public fund, it sits privately. And I think that's forced more asset managers to allocate investments into alternative assets. In my career, spanning north of 30 years, I was mostly in capital markets, working for large banks as a trader / equity capital markets in helping with companies with liquidity on the public side. And I think in the course of my career, I've watched everything go from analog to digital as far as trading and markets. And when I came across NASDAQ Private Market, I'd been working at a fintech startup to modernize the IPO and the follow-on process for public companies. And in the process of me doing that, I found that there were a lot of banks and global investors that were asking for more infrastructure, more data, more transparency, more process, more institutional process for private companies. And I think that's ultimately how I got connected with NASDAQ Private Market. And so when I joined in 2021, we spun the company out of NASDAQ as a standalone company and took on outside investment from a number of banks, including Goldman Sachs, Morgan Stanley, Citigroup, Silicon Valley Bank, and Allen & Company. And that premise that this asset class is going through a transformation from fragmented and frontier to more institutionalized, and the need for having a regulated solution, for having more consolidated liquidity, for having better price transparency, for having better data, and making this asset class look more like a traditional asset class in the sense you've got the banking system entering it is part of the premise of why NASDAQ Private Market was spun out of NASDAQ. And then last year, 2024, we added Bank of America, UBS, Wells Fargo, and BNP Paribas. So we're owned by a big consortium of banks, and we have invested heavily in infrastructure, as well as data, as well as technology. I think a lot of people think that we're an exchange and these are listings, and that's not true because these are private companies. They don't have to list their shares. We are not an exchange per se. We are a technology company. We are a regulated ATS, which is a little bit getting in the weeds, but it's one level below an exchange in the sense that we're regulated by the Securities Exchange Commission and then by FINRA. So there is that regulatory oversight and compliance and process. But at the end of the day, these private companies are staying private for a long time, and they want to ultimately also control the liquidity that they have in their cap table, which means they want to do either periodic tender offers, they want to do periodic liquidity programs, and they also don't necessarily want to just allow any investor to be in their cap table. And so they can control the transferability of the shares, whether they're pref or common. And companies have this, what we call ROFR, the right of first refusal. They can reassign trading interests where they may not want a competitor or a non-strategic investor in their cap table. And so that allows the company to control a bit of who their cap table is. And so NASDAQ Private Market came along with this concept of the tender offer, the modern tender offer. And it was developed with a law firm. And the idea was that you can basically pull some liquidity out of the shareholders in the sense of usually you have employees or founders that need at some point to monetize some of their hard work and their gains. And especially if I just said the companies are staying private for so long, you have to allow for some regular liquidity to keep employees happy. It's employee retention. They can go work for a public company, get paid in public stock. And at some point they know they can sell that because it's in the stock market. But if they're going to work for a private company and you're paying them in equity, at some point they need to buy a house in Silicon Valley, for instance, which is really expensive. So they have life events. And so you need to allow for some liquidity for employees. Founders would like to also, frankly, monetize some of their successes as well. And so the modern tender offer really was developed to help companies achieve strategic liquidity. And we actually see now a lot of larger companies do that on a fairly regular basis. Once every 1 to 2 years, they typically will need to do some sort of liquidity option. And it is typically a company that's been around for 6, 7, 8 years. Average market cap's around $2 billion. Number of employees is about 500. It's still not going to displace the seed and sort of A round where it's seed risk capital. That's really much still the venture capital's world of knowing a company, being a good board member, advising them. And most VCs are making a 7 to 10 year investment. So the early stage still is really very much still VC focused or at least private equity focused. But it does see a trend where A and B rounds are now much bigger. And I think A, B rounds also are companies that have been around for a while longer. And as a result of that, you can see a 5-year company, a 3-year company that's rocketed in valuation and has done a large A or B round and has enough shareholders that they would want to allow for some sort of liquidity. And I think so it's definitely moving earlier than it historically was because it was typically more later stage and they just decided they didn't want to go public, but they had to solve a liquidity problem. But it is migrating towards earlier stage companies, but not, I would say, probably the seed or early rounds.
Some questions or number of questions are bubbling up in my mind in terms of size. I think you've answered the question about size, but what about particular industries? Are there any industries that you shy away from, or are you industry agnostic? Would you invest would NPM invest across a wide range of industries, or tell me a little bit?
Most of the companies we work with have some sort of growth equity component to it. So it's going to be a tech or a healthcare tech. But look, tech's going into everything. It seems like we've got amazing defense companies now.
Healthcare, defense.
First, right? You've got SpaceX, which is the largest private company valuation really in the markets, and they're a space company. It's more tech growth equity than it is hard assets, say real estate, for instance.
Okay.
But again, then you get into, say, infrastructure, where if you need to power AI and you need energy companies, or you need new energy sources, or you need new energy infrastructure to help AI, they can very much look like a growth equity company themselves as well, because they're serving part of a broader trend with an emerging asset class or emerging sector, like artificial intelligence as an example. So I never like to answer that where I'm saying, yeah, it's got to be a software company or it's got to be a fintech company. It's really not. It's actually tech first, but it's tech into whatever industry is utilizing, whether it's AI or using some sort of tech component. We do work with like hospitals and partnerships occasionally, because larger partnerships also need to transfer ownership periodically. And ultimately, we're agnostic to that, but that's more of a bespoke scenario. Typically, what we'll work with, like I said, are a unicorn level company. It can drop down to $300, $400, $500 million company here in the US, because again, if the cap table and shareholders and employees are big enough, you're going to need to have a liquidity solution for that. You can adjust that for other countries where maybe it's a smaller market cap, but they have a large enough number of employees that they need to solve for that liquidity. But that's the core business and the core clients, the issuer. What we've also built is a global marketplace, because again, going back to the duration issue, which is if a investor, so VC, private equity asset management firm, has a fund that's a 7 to 10 year vehicle, and your exit's 14 years on an IPO on average, you've got a duration problem as far as your exit strategy. And having liquidity is you only want liquidity when you need it. As a result of having our brand and our connectivity to global banks and our connectivity to global investors, we have built a secondary marketplace so that investors and employees and intermediaries can come to a marketplace, try to find some price data, try to find some valuation data, achieve some liquidity, and ultimately look to transact. Of course, again, unlike most other asset classes, this is really what we call a trilateral settlement market, because you've got to have a buyer and a seller agree on a size and price, but then you actually also have the company that has to approve that. And that's what's unique about other asset classes. If you and I have a brokerage account and want to go buy Apple or Google, it's a bilateral settlement. If we go buy another derivative credit instrument, whatever, it's going to be probably a bilateral. This market's unique in that way because the company gets to control the transferability in a lot of cases, not necessarily for pref shares, but definitely for common. So that just adds one nuance to the process. And a lot of investors want to be able to know that they can find liquidity, and then they have to ultimately notice the company to see if the company will approve the transfer. What we have found is that we have worked with a lot of private issuers to streamline that actual process. And so we basically use our technology to help the stock admin, the general counsel, and the CFO, and even the founders come up with a more streamlined way for them to transact and settle shares. And especially if they're also not running a company program at that point in time, if they're 1 to 2 years away from that, what do you do with all the people in between? Or what do you do with the investors that need to return DPI, or they need to return LP capital at the end of life of a fund? And I think that's something that when I talk to the VC community and I talk to Silicon Valley in general, is just the idea that VCs are very good about picking good companies and investing in them, but nobody has really addressed the bigger issue, which is that the exit's now becoming a much bigger problem. And I think there are larger VCs that are addressing that in various ways through continuation funds, becoming a 40 Act investment advisor, and coming up with other solutions, other secondary funds just basically buying portfolios for them and putting.
We call it pass the parcel. to
That's the parcel.
your
Yeah.
other funds. But unlike, if I could just interject for the clarifying question, unlike traditional private equity funds that are typically, they have their investors and then they put the funds to work, and if they've raised the fund already, they don't typically have to go back to those investors to get approval for making specific investments. However, for them, profitability is paramount. At least certainly the private equity funds that we work with that are buyers of Silicon Valley companies that we're selling. So it sounds like your model, even though profitability is probably important to your model, I'm assuming, your model is different in the sense that you don't have like a fund necessarily sitting there, that you have discretion over making the investment. It sounds like you very much have to.
We're not direct investors in the cap table typically. Like, we are a service provider. We will we went for bigger companies, it'll be thousands of participants. That's a lot of legal agreements. That's transferring hundreds of millions or billions of dollars. That's updating certificates of ownership and records. And that's the core of the tech. But then out of that, you get a network effect. So you get more participants joining a more centralized place globally. You get efficiencies by standardizing process so that not everything has to be bespoke. You get reduction of settlement times. You get, again, pools of liquidity. And so we're providing all those things to the market, as well as expertise, because we're the subject matter experts, because we ran, I think, worked with over 70 companies last year at about $7 billion of notional proceeds rates. And if you do an apples to apples comparison, that's larger than the US tech IPO market. I think Morgan Stanley had it at 5.4, 5.5 billion.
Interesting.
I can't compare it to the entire IPO market. You've got SPACs and you've got other fund vehicles in there.
Right.
But as far as an apples to apples comparison, we did more volume last year than the US tech IPO market. And that just, again, shows you that these companies are wanting to stay private for longer, but still need solutions. And so that's sometimes working with the company to achieve what they're trying to produce. They want to provide liquidity for employees. Do they want to get some new cap tables, especially if the company's valuation has gone up enough? That's historically where a company would have gone public, because now you start to attract the professional money managers, because they can write a big enough check now because the valuation's big enough. If you're a $500 million company, you're only going to do 10% of liquidity. Somebody that is a big asset manager may not want to write a $1, $2, $3, $5 million check because they manage so much money, it just doesn't matter. But if you get a $2 billion company that wants to now do $200 million or whatever, all of a sudden professional asset managers can now write a big enough check to invest in the company, and it's some deal flow they want to see. And that's typically because the valuation of the company's gone big enough. So as far as profitability, that's up to the fiduciaries, the professional investors, to do their own modeling and to their own portfolio selection. Obviously, AI has been a very hot space, and I'm not sure all these AI companies have figured out
a lot of them aren't profitable.
Business model. I'm not going to pass judgment on that. We don't give advice. We're not a bank, but I will say that's really up to the fiduciary community to determine those investable assets. But you do get a lot of potential valuation increase relative to the profitability or to the revenue model.
FEI Silicon Valley is Silicon Valley's leading professional organization for corporate financial professionals and tax executives. It's one of over 50 chapters of Financial Executives International, the leading financial network for CFOs, advisors, planners, and more. FEI gives over 9,000 executives around the world a toolkit of ways to share best practices, opportunities, and connections. Boost your professional opportunities by going to www.feisv.org.
We alluded to, I'd like to go back to the topic of valuations, because we touched on it before. And certainly that's one of the pain points that a lot of VCs, even with later stage companies, are experiencing or have been experiencing. And with this recent correction in the market, we're living in interesting times, till we put it that way, with the market decline. So I'm wondering if some of that correction may help solve the valuation problem. But then again, we have all these private companies sitting in portfolios that have been invested in at very high valuations, and they're trying to figure out what's the next step for liquidity. So Maybe talk to us a little bit about the recent market correction, how that's been impacting your business. Maybe it's caused an increase in business and more realistic valuation expectations.
Yeah, I think as I was chatting with you before we started the podcast, I've been in markets for over 30 years. So I've lived through a variety of up and down cycles, cyclical cycles and the secular cycles. And I think I alluded to that. I think the financial media is just reporting about what's happening today. And I think that recency bias gets filtered into all kinds of explanations. And you have to be able to sit back and look at the secular cycle. And I think that's where you can actually then make bigger decisions about your own investing or about your professional investing job. And public markets have the benefit of having real-time pricing. So when you see a large correction though in the markets, that typically lags into the economy, it lags into less liquid asset classes. And that's certainly true with our market in the sense that because we're not real-time everyday stock market, we're more periodic, episodic liquidity. We do have data on 300 of the biggest companies, and we have liquidity in hundreds of companies. They also tend to be a lot of times one way in the sense that it's a hot company and everyone wants to buy it, or it's a declining company and everyone wants to sell it. And the equilibrium is harder to get to. And that's ultimately why you do need corrections, because you can't just have an up market the entire secular cycle, because you're just going to get massive valuations, and you're also going to get potentially a bubble. You're also going to get people that, are trying to chase assets they can't even buy. And the flip side of it is obviously if everything's for sale, no one wants to buy, no one wants to pick the bottom. And so you have those inefficiencies in market behavior. So in some ways, corrections are healthy because it takes some of the valuation change. I think I don't want to speak to venture capital portfolios. I'll leave that to the venture capital pros. But I will say from our vantage point, you had a 10-year zero interest rate era where rates were basically zero or thereabouts. And so you had a lot of risk-free capital. And so I think coming off that zero interest rate era and the end of the COVID era, 2022, call it, I think you did have a lot of companies that had raised capital at a high valuation because of that zero interest rate decade. And so I think that some of those haven't fully corrected, or some of those valuations haven't fully come back to earth. And that just happens, especially for companies that have raised all the capital they need, and they don't really need to take a new valuation or the down round mark. They can hopefully wait out that that market correction and hope that their valuation doesn't change. But again, at some point, these companies have to offer liquidity to either employees and or investors. And as a result of that, at some point, they are forced to realize that they're going to have to take some sort of valuation change, even if it's at a discount. Again, I'll leave that to the VCs and the issuer communities, but I will say that you do get this sort of delayed response where some companies don't want to risk taking a
right. And I'll say absolutely have to get liquidity of some sort. Exactly. Unless they're absolutely in need. Yeah. And back to your point about living through lots of different cycles. I've been in this business for 35 plus years, the M&A business. And certainly I've seen a lot of market cycles too. And I think back to the financial crisis, 2007, 2000, the subprime crisis, and then the dot-com bubble prior to that in the early 2000s. And then we can go back to the late 90s. But it seemed, I guess, thinking of the recent subprime crisis, it seemed like, okay, the problem was identified, and then the professionals, including chairman of the Fed and all the professionals in the market, were working together, government and business, to figure out a solution, how to prop up the companies that needed bailouts and how to calm the markets. And it seems now, and this is my feeling or my opinion or my worry, that this time it might be different. And this time, because we don't know where the next surprise is going to come from. And one thing that businesses and markets hate are surprises or fear of surprises. And it just seems like we've got, chaos reigning. And I'm just not sure where the calm or where the solutions are going to be in the market. And maybe I'm being a victim of perhaps some press, but I just worry that this time it may be different. And where
I've heard that in my career a lot. And every time you hear this time's different, a lot, ultimately, if you bought or you invested in big corrections 5, 10 years later,
Right. You're doing great.
you're higher. And I
Right.
mean, when you look at the dot-com era, there were a lot of business models and a lot of companies that probably should have never been a public company or should have been in business. But you also
Right.
got infrastructure built that ultimately led to much faster internet, a much more efficient internet. I would argue that you even eventually we got the wireless mobile phone universe out of that. And here we are in this other secular cycle with artificial intelligence, which is a huge secular cycle. It's 5, 10, 15-year cycle, and it's going to have its ups and its downs. I think I've just been through this enough myself that it's too hard to assess in the point of time that you're in to know what the long-term effect's going to be. Markets will settle down. I think you are right. Markets hate uncertainty. And I think that's part of what's going on right now is just there's a lot of uncertainty on policy and uncertainty in general. I think that will subside as well. It always does. But yeah, it's definitely a tough period right now for sure. But I've also learned not to watch the daily media and financial press to see what happened today versus yesterday. I think it's going to ultimately need to be about good business models and valuation and paying the right price as an investor for that investment.
Yeah. I take some comfort in that. And I guess my only concern is I look back to the crash of 29, and then apparently a lot of economists say if it weren't for Smoot-Hawley and the tariffs that were imposed in 1930, then the Great Depression, the stock market crash would have corrected and the Great Depression wouldn't have happened. But hindsight it's hard to analyze things. And it's such a very different environment these days on scale and just about every which way. But anyway.
Knowing history is important. You're right. Smoot-Hawley had a much bigger, if anybody studied that era in economics, Smoot-Hawley was a big factor in the Depression. And this time is not going to be the same. You won't know. But you're right. It's just good to know history. I think I'm ultimately bullish. I believe in technology advancement. I believe that we're in another new wave of incredible growth in artificial intelligence that's going to come into a lot of things in our lives. Look what's going on in healthcare is a great example, and really cancer detection and things like that. That's why it's fun for me to, as a practitioner, meet founders or meet companies and employees that are really building amazing products or amazing technologies, forwarding incredible innovation. I think that's really important. I think that's where I stay positive, is that innovation is continually getting our lives better. And I think that's where I tend to still sit.
Yes. And definitely our healthcare system can use a lot more technology to make it much more efficient. There's no question about that. Let's focus a bit on the international. That's your primary role, leading the company, your NASDAQ Private Markets international efforts. And you've had some travel overseas in the Middle East, and you're off to Asia. And give us your perspective on some of these international markets. Maybe start first with the Middle East.
Yeah, until last summer, I was the co-CEO of the broker-dealer marketplace and ran the capital markets group. And so over the last 4 years, had assembled a team, built a marketplace, built technology. And so I think we got to a place where we wanted to make sure that we could expand our footprint globally. We've got a strong brand. We've got global banks that own us. We've got global companies that people want access to. We represent some of the biggest private companies and transactions. And so I think getting to know more of our international partners and international investors and service providers was part of sort of my new role of doing that discovery. Yeah, I mean, I just got back from the Middle East, and there are amazing companies over in the Middle East. And that's not just like
oil,
or Saudi, or it's also Israel. It's other places. And I think generationally, you're also seeing the next generation that has grown up now with mobile phones and are very tech savvy. And I think that innovation will propel more innovation. Look at the ride apps globally now. You can pretty much hail a taxi or a Uber or whatever in whatever country pretty easily on your mobile phone. That wasn't the case 5 and 10 years ago. So just as an example. So I think part of that is just that there are emerging technology companies that are global. They're not just US centric anymore. And you've got a lot of countries that are pro-market and incentivized to propel their economies through innovation. And we can be helpful to those companies and to those investors globally, because we've now done this for over a decade with some of the biggest names. And part of my role is to go, help work with international companies and international investors and international service providers. And so that's my role, to go meet those various entities. Yeah, Asia is also very interesting because you've got changes going on or like a Singapore is really becoming like the Switzerland of Asia, or Dubai is becoming the tax-free asset capital for, frankly, I would say not just Asia, but I would say Europe too. Japan is deregulating their economy because they've got too many public companies that are just forced to go public at a very low valuation, and then there's no liquidity. And I did hear a great stat from Ambassador Rahm Emanuel last fall in Japan. He said that 1/3 of all the graduates of the university system are going to startups. And I think that's a cultural change where it used to be Japan Inc. and you'd go work for a company.
Right.
That's just commentary from a reputable ambassador. So I can't say that I can back test that, but I think that, again, this next generation is very tech savvy. I mean, my kids, as an example, are way more tech savvy than I am. And so I think you get a lot of innovation and entrepreneurialism out of that. And so that's exciting because it is not going to necessarily just be US centric, that there are going to be, whether it's South Korea, Japan, obviously China with their own technology and their own issues, Singapore, India, Middle East, pockets of Europe, and even pockets of South America. And Latin America. So there is a growing demand for companies that need help structuring the right liquidities. They want to stay private globally. And there's equally the amount of demand from investors that want to be able to invest in those companies and find a way to get opportunities to invest in those.
So you are going to each of the countries you go to, you are lining up meetings not only with the companies themselves that are seeking the liquidity, but you're also meeting with major investors that are looking to invest in those types of companies, and so that you can essentially broker or play intermediary role between those within those countries. Or are they looking, say, the investors you might meet in Dubai, are they looking to invest in US companies, or is it very much cross-border, or is it mostly within each of those countries?
Yeah, that's a good question. Today, it's mostly cross-border because a lot of security laws haven't adjusted for this sea change in private versus public. I do actually spend a lot of time with policymakers and governments and regulators because they see the United States has historically led. And so given that we have a robust VC ecosystem, given we have now a 10+ year track record of lots of unicorns, and there are 900 to 1,000 unicorns in the US, there are 1,400 globally. There's only $2,200 billion listed US companies in the public market. So the spread is collapsing between public and private billion-dollar valuations as far as companies. But policymakers are very interested because they also know that this potentially creates jobs and potentially more economic growth. It's kind of all the above. You talk to the governments and regulators and policymakers, you talk to sophisticated global investors. It's not even so much trying to, as you said, broker or trade. It's actually best practices. You go approach a sovereign wealth fund or a corporate venture capital firm or a large VC, and they have a portfolio of companies that are at different stages in their life. And talking to the investor who typically would sit on a board or knows the founders or helps that company, it's bringing awareness that you can stay private for longer if that's your choice, and you can have solutions for liquidity to retain client or to retain employees, to work with your investors for potential liquidity options, to keep your innovation going by staying private. And I think that's still, I find myself doing a fair amount of educating that people don't realize that. And I think that's part of the broader theme here and message.
That you can stay private and still have liquidity, adequate liquidity.
Not for everybody, but
yeah, it's possible.
It's very possible. And we've shown now over 10 years with all the companies we work with, that's in fact true. Now, I'll also sit here and tell you that some companies should be public. Some companies have too many investors or they're big enough. Liquidity should be something that's more
broader.
And broader. And I mean, there are some flaws. Companies pay employees in equity. Those employees, that's technically compensation. So they should be allowed to sell it at some point, not just whenever. You also want the growth and innovation of a country to sit in a more savers portfolio. If you look at a lot of the professional money managers that are investing heavily now in private assets because they want to offer more access to private growth equity companies so that the savers can actually have exposure to the asset class, which is broadening out the capital market system. So that's another piece of it. We do have this sort of incentive problem where you've got public companies that report quarterly earnings. The incentive is all about the short term, right? It's ensure that your stock price stays up and your earnings are in line or beat expectations. And if you're a management team at a public company and you miss earnings or you're underperforming, you might get fired. And so your incentive is to make sure you get your stock price up and your earnings good. If you're a founder of a private company and you have 7 to 10 years of VC investment in you, and you're periodically going to have to raise maybe another round, you're talking about trying to get innovation. You're talking about trying to get long-term capital formation, trying to get a nice multiple valuation upticks, et cetera. But you're not looking at 3 months. You're looking at 5, 10 years. And I think that's a little bit of obviously the mismatch in incentives between public and private too. When you're running a company, you're thinking about, enterprise value as a private company. Public company, you're thinking about stock price. Now,
quarterly,
that's generalizing it way too much. But
no, it's so true. Your focus is quarter to quarter and where the stock price is. I wonder, Brett, there are a number of products, specific products that caught my eye, and I put them up on the screen here just so perhaps we could talk. Are there any particular products that you would like to highlight for the NASDAQ private market? And I guess the products are broken down into the trading marketplace. So secondary market, employee trading, investor trading, bank and broker technology, then company platform and liquidity platforms, tender offers, auctions, capital introduction, option extensions, pre-direct listing, and then there's also data analytics and also settlement. Are there any products there in particular that you would like to highlight that you think our audience should be more aware of? Anything that's innovative or unique to NASDAQ private markets that you would like to highlight?
I'll just start with the core client and the core business, which is the issuer is the core client, typically has been since we started. And the core product is liquidity programs for private companies. And that's obviously in the middle. And that's addressing a real need. And from there, we built the company with other products and other services. As I said a little bit earlier, if a company is not active, what do? If you want to buy something, you want to sell something, you have to return LP capital. You're a fund advisor and you want to build a position in 10, 50 private companies, then you probably need to go to the marketplace. And then if you want to go to the marketplace, how do you know what the valuation is? How do you know what the share price is? How do you know? That's one of the, obviously the benefits of public markets is you may not like the price today or last month. You know what the price probably is on any given second or any given day. It's a little bit harder in this market. And so we spent a lot of capital investing in data so that people can have a better understanding of what the valuation and sort of price per share potentially can be. And the data is a big component of that, because if you are an investor, you want to know what the price is and what the valuation is. And I think that's been one of the barriers to entry to this asset class, is just not knowing what the real sort of value is or the fair market value is. And we're not saying that we're giving fair market value, but what we are saying is we provide a source of truth, publicly available documents that we have spent a lot of time producing to more of a digital format so that people can consume it, so they can actually do their own homework, their own diligence to determine if it's a price that they like and a valuation they like. The transfer and settlement piece there is important too, because this is a still relatively inefficient market. And how do you create efficiency? One of the ways you create efficiency is through standardization. So that not everything, like I said earlier, is bespoke, that you can create a process for the company to basically streamline the ability to transact. And so we've worked with a lot of companies, dozens of companies, to use technology to streamline the settlement piece of this, or just the transferability of it. And we will continue to do that going forward. And that ultimately then reduces settlement cycles and settlement times and not knowing whether you can buy or sell something. And we still give the company complete control, because remember, these are private companies, not public companies. So ultimately the companies can control the transferability a lot of times of the common. The pref stack's obviously a little bit different.
Yeah. So in summary, if our listeners are thinking, who do you serve? I guess it breaks down into, maybe 5 major buckets. That you've got employee shareholders, for instance, selling pre-IPO shares. You got banks and brokers that, maybe want to leverage the technology and scale different private market franchises. You've got investors, that want to buy and sell company shares, but private company shares, and obviously private companies that want to create their liquidity programs, leverage transfer and settlement, and then also law firms. And we haven't really talked about that, but a lot of law firms, or especially corporate cradle to grave law firms that would probably have a number of clients that need to do secondaries. So you would support law firms that have those kinds of clients as well.
Yeah, law firms certainly should be mentioned here because, and I think if you speak to a CFO that's listening to this, or to a GC, or even to founders, a lot of times founders aren't the subject matter, the security laws experts, and so they go to their outside counsel, or if they have big enough, they have their own internal counsel, but they're asking, hey, can we do this? How do we deal with this? We have options. We have a cap table cleanup situation. We have vesting shareholders, employees. What do we do? Can we do this? Is it going to affect our valuation? All these different questions that the law firms are obviously the experts on. And a lot of times we'll get law firms that will bring an issuer client to us and say, hi, we worked with you many times before. We have another company that we really need to help them figure out a liquidity solution for them. And so we become just a good service partner to even the law firm franchises. And they tend to be, a lot of the time, people, that's where they uncover a lot of the opportunities because they're talking directly to the company, that the company doesn't know that they can do this. And the bigger law firms know that they can and has been done. And so then the law firms basically work with us, with the company on that. So that's definitely an important piece of the ecosystem for sure.
Yeah, I wanted to highlight that because certainly at FEI Silicon Valley, and I think a lot of the FEI chapters, we have law firms that are also our sponsor partners that might be listening to this. So last question, we're coming up to the hour here, but last question, crystal ball, if you will. How do you see the rest of 2025 unfolding? We're just early into Q2, and there's been an interesting Q1 for sure. And I'm just wondering if you have any sort of thoughts on how the year might unfold or what you see ahead for NASDAQ private market.
Yeah, I'm certainly not a chief economist or chief market strategist, so I'll leave that for the experts. But I mean, again, short term is always hard to predict. Uncertainty is bad for markets and for investors. They want to know predictability. So I think those are some of your short-term issues, along with everything else that's going on. But look, again, I remain optimistic because I've now, in my 30-year career, rode this technology wave from literally like free Windows in Microsoft and, mobile phones. Yeah, I think innovation is great. And I think we have this system of deep venture capital that supports entrepreneurs with a crazy idea. And they get funded and then they go out and build an amazing company and hire amazing people. And those companies succeed. And then people that invest in those companies are able to also participate in the success of that. And I think that's a good ecosystem that we have in the United States that I, frankly, as I travel around the world, many countries are envious of. They wish they had what we have, which is a very deep capital market, including the VC risk beginning piece of it, and innovation and the capital that fuels that innovation, that entrepreneurialism that truly creates that innovation. And I think that is, when you ask me crystal ball, I believe in the long term. The long term is that I've seen nothing but innovation and technology and society be more innovative and with better technologies and products that enhance our lives. And I think that's why I'll stay optimistic, even if you've got, some near-term craziness, and I don't know how long that.
Yeah. Well, thank you for that. That is definitely provides me with some comfort as to the year ahead. Well, Brett, this has been fascinating, really insightful, and I'd like to thank you very much for participating in our podcast. And I'm sure that we'd love to have you back again, perhaps later in the year, and we'll see how things have developed and get an update on.
Yeah. Well, luckily I didn't make too many predictions, so if I'm wrong, but no, I appreciate that, and I thank you for this conversation today, and I look forward to talking with you again and seeing where things stand.
My pleasure.
Thanks for listening to The Strategic CFO. To learn more about FEI Silicon Valley, go to www.feisv.org. You can find our posts on Jan Robertson's LinkedIn or the Financial Executives International Silicon Valley LinkedIn page. We'll see you next week on The Strategic CFO.